If you own your home and you're thinking about tapping into the equity or you need some cash, you've been probably considering a couple different options. One being cash out refi, and the other one being a home equity line of credit, also known as a HELOC. And you're probably asking yourself, which option is better for me? Well, the answer is it depends. And so in this video, I'm going to break down the differences between the two and when one would make sense over the other, and some mistakes that I see people make when they're deciding on the two options. So first and foremost, what is a cash out refi? Well, cash out refi is replacing your first mortgage and then adding on the additional amount to that mortgage for the cash that you need. So for instance, if you have a $400,000 home, a $250,000 balance on your first mortgage, and you want $50,000, you're gonna take out a new first mortgage for $300,000. Then if you have a home equity line, you have the same scenario, a $400,000 home, a $250,000 first mortgage, you would take out just a new line of credit for $50,000. You would keep your $250,000 first mortgage, and now you have a $50,000 line of credit that you can utilize. And so what are the key differences between the two? Well, first and foremost, as I mentioned right away in the beginning, a cash out refinance is going to include one payment, where a home equity line is going to have a first mortgage and a second mortgage, so you're going to have two payments. The next part of it's going to be your interest rate. Your interest rate on a cash out refi is typically going to be fixed, where on a home equity line is usually on a variable rate, and it's dependent on whatever the Fed rate is at that time. So as the Fed goes up, your interest rates could go up. As the Fed rate goes down, your interest rates could go down as well. So one is very predictable. The other one is going to not be as predictable. So your payment on your cash out refi will be steady, and you'll know what it will be every single month, where the variable interest rate on the home equity line will cause some variability in your payment as well. And then the access to the funds. When you replace that first mortgage, is in our first example, when you take out that $300,000 new first mortgage, the $50,000 comes to you in one lump sum. You begin paying interest on that $50,000 as soon as you receive it, or once you close on the loan and the rescission period is done, you now have the $50K, you're paying interest on it. A home equity line only bears the interest for the amount that you're using. So in our example, if you took out a $50,000 home equity line, but you're only using $10,000 of it, you're only paying interest on that $10,000. The other unique part of the home equity line is the fact that you have the ability to draw as much as you want, pay it down, and then you can come back and use it again. Cash out refi, $50,000, you pay it down, there's no ability to go back and borrow more money. A home equity line gives you the flexibility where if you borrowed $40,000, paid it down to zero, you could go back and now borrow the $50,000 again, or $40,000, or whatever amount that you want to use. And so some common mistakes that I see people do is, one, they don't think about the length of time nor the cost between the two. A cash out refi is typically going to have a little bit more cost associated with it. And so it's going to be something where it's going to be a longer term plan, because you're going to have some additional costs. So for you to break even on those costs and for it to make sense, you should have a longer period of time that you expect to stay in the home. A home equity line doesn't bear as much costs. And so therefore, if you're gonna live in the house for maybe another year or two, that option probably makes more sense. The other really big difference between the two of them, if you've bought your home in the last couple of years and say your interest rate is somewhere around that 6.5% to 7.5%, a cash out refi might make sense for you now because the interest rates are lower. So if you could get the cash that you want and an equal or lower interest rate, it's a double win for you. If you bought your home years ago and you have a really low interest rate and you don't want to touch that interest rate, a home equity line will make sense for you, because now you can keep that larger portion of your mortgage at the low interest rate and then get the home equity line at the higher rate and not affect that first mortgage. So those are key to think about. The other part of it is not taking enough cash out. So make sure that you plan ahead, know how much equity you need, and make sure that whenever you take out that line or you get that lump sum of cash, it's going to cover the expenses that you have. And then last but not least is consider consolidating some debt when you do either of these loans. Why? Because it makes everything a little bit more affordable. Depending on your interest rate on your automobiles, or if you have some high interest rate credit cards or some other debts out there that you'd like to consolidate, this might be a great opportunity for you to consolidate some debt and now make the payment more manageable and allow you to be able to pay it off quicker and by avoiding some of the higher interest rates. So keep all of those things in mind when you're going to choose the two. Now, when is it going to make that much sense to do both? Well, in a case where if you're going to borrow, let's say, for instance, our first example, if you had a $400,000 value of your home and a $250,000 mortgage, and you needed $100,000, well, guess what? Cash out refis and conventional financing have a maximum debt to income ratio, and that's usually going to be 80%. So in the world of a $400,000 home, you'd be able to borrow up to $320,000. Well, $250,000 to $320,000 is $70,000. So you could do a cash out refi for $70,000, but if you still needed an additional $40,000 after you close on that first mortgage, then you could still add a home equity line of credit up to $360,000, which would be a $90,000 maximum loan to value, which most home equity loan products will allow you to do. So you can use some strategy, you can get creative with this to make sure that you get the amount of money that you need, utilize your home as an asset, and tap into that equity. If you have any questions or need some strategy, feel free to reach out to me. We can discuss all of your numbers, look at the whole financial picture, and make sure you make the best decision when it comes to tapping into the equity and pulling cash from your home. I hope this video helps. If it does, please like, follow, and feel free to share with other people that you think that could use the same strategy that I've just described in this video. Thanks for watching.